Hello, everyone. My name is Emily Scott, and I'm with Local Initiative Support Corporation. I'd like to welcome you to the Opportunity Investment Consortium of Indiana's Opportunity Zones, What Do Indiana Small Businesses Need to Know webinar. We are really excited today to have more than 110 individuals registered for this webinar from multiple states throughout the country, representing public, private, and nonprofit sectors. So having so much interest really speaks to the value of what we hope our panelists and participants will be able to share with everyone today. I'd first like to go ahead and introduce our speakers to you. So again, my name is Emily Scott, and I'm with Local Initiative Support Corporation. LISC is a national community development support organization, and we worked here in Indianapolis for more than 25 years to support community and economic development partners in urban and rural neighborhoods throughout the country. LISC has served as the backbone for the Opportunity Investment Consortium of Indiana since its founding in November of 2018. And our partners today represent various technical assistants and resource partners that are members of the consortium that work throughout Indiana to support Opportunity Zone transactions and other economic development projects. Our first panelist will be Stephen Lukanovich with MCM. Stephen serves as director of the firm's real estate services team and transportation logistics services team, and is a member of the tax services department. He is also a partner in charge of the Jeffersonville office. His practice emphasis is providing tax advisory services to real estate businesses, company transition services to small and middle market companies, and valuation services and estate and succession planning. Stephen is an active speaker and lecturer on topics related to real estate industry. Chris Kaufman is with Frost Brown Todd Law. Chris is a member of the Louisville and Nashville offices of Frost Brown Todd. His practice concentrates on tax planning and civil tax audits and controversies. Chris has represented clients in administrative proceedings before local and state taxing authorities and the IRS. In addition, he has represented clients before the U.S. Tax Court. Chris helps lead Frost Brown Todd's multidisciplinary Opportunity Zone service team. Lindsay Malici is an economic development specialist for the Indiana SBA office, where her role is to connect small businesses and entrepreneurs with counseling, capital, and contracting services. Lindsay previously held positions with the state of Indiana and Ohio, as well as a local economic development nonprofit organization. Matt Toohey is a program manager with the Indiana Economic Development Corporation. Matt manages compliance and reporting for the 21 Fund, the state's venture capital program, State Small Business Credit Initiative from the U.S. Treasury, and Indiana Capital Access Program, Motorsports Improvement Fund, and portfolio management of a variety of other programs and public-private partnerships. So just a little background on the Opportunity Investment Consortium of Indiana. This multidisciplinary platform was established to help both public and private sector partners connect to investors and resources to help further projects in both rural and urban communities throughout Indiana. The platform, which aggregates resources and opportunities throughout Indiana, has been referenced throughout the country as a best practice in terms of developing a multidisciplinary platform to support Opportunity Zone projects and resources throughout the state. So I'll first like to hand it off to Chris and Stephen to give you an overview of small business resources for Opportunity Zones.
Well, very good. This is Stephen Lukanovich, and sitting with me, of course, is Chris Kaufman, and we're delighted to be here today. Thank you for the good introduction. So we're probably certain many on the webinar today are remotely familiar with Opportunity Zones, and probably many are fairly familiar and are just curious what's taking place in Indiana. So hopefully we'll get into that. But as a reminder, we want to touch base and just sort of talk through exactly what these Opportunity Zones are all about, what the incentive is broadly, some significant dates that have taken place, and generally how the whole structure typically looks. And then Chris will get into the recent legislation, which I'm certain many are aware, passed December 17th. It's the final regulation, and there were two earlier proposed regs. We'll talk about those here in a second. So Chris will get into the final regulations, and it answered a lot of questions that many investors and entrepreneurs had about the program. So we'll talk about that as well. So next slide. One, the legislation, the Opportunity Zone legislation passed with the tax reform legislation. Last time we had major tax reform in this country was 1986, and so this was major tax reform. Included in the major tax reform legislation were opportunity zones. Opportunity zones had not existed prior to December 2017, made effective 1/1/18. We've had GO zones, enterprise zones, but we've never had opportunity zones. So that's all brand new legislation. It was codified in Code Section 1400Z-2. Next slide. So some significant dates. The legislation, the Major Tax Reform, Tax Cuts and Jobs Act passed December 22nd, 2017. Again, that was sweeping legislation. Tax rate reductions, as many are aware. We had many entrepreneur clients and flow-through companies get a free 20% deduction, no questions asked. That was all brand new in the legislation, and again, including the opportunity zones. Then October 19, 2018, we had the first round of proposed regulations along with a revenue ruling that was released near that time. And it outlined some first series of guidance that many were looking for. So the rule itself was actually pretty helpful in December, but obviously you get into the details and you get into the specific project. October provided some guidance, and in October of 18 provided some guidance. And in April of 19, a few months later, that was really our last set of proposed rules that were released up until the final rules that were released in December of 19. And April really put a twist on a few things that honestly those that were in this space, as an example, the Section 1231 gains and how those can be invested. There were a number of taxpayers who incurred capital gains, in which I'll explain exactly how this works here in a minute. And then if you had a 1231 gain, a 1231 gain is generally the sale of depreciable property, which is real estate or business property. You could not invest until year end. 12/31/2019 would be the earliest you could have invested, and that's what one of the prohibitions that the April 17, 2019 rules gave us, but that's since been fixed, and we'll talk a little bit about that as well. And then on this slide, you'll see the Form 8996. That's the Qualified Opportunity Fund self-certification and this semi-testing that takes place on that form by the fund. And the fund is nothing more than a partnership, and we'll talk about that as well. And then Form 8949 is the form that's used that investors file with their individual tax return substantially. That's generally where this is applied, is at the individual level, not totally, but mostly. And Form 8949 is where the investor makes the election to defer their gain. And we'll talk about that as well, exactly what that means to defer a gain. Next slide. So each governor of every state, including U.S. territories, were designated with the authority to select the census tracts that are known as opportunity zones. So, Chris, as an example, in Indiana, I think we have, what's the number of census tracts? Is it 144 or something like that? Does that sound right?
Sounds right.
I think that sounds right. Anyway, each state has census tracts, and each governor by March of 2018 generally were required to select these designated areas that are known as opportunity zones. So those have already been selected. There were some, I think, some extensions for some of the governors who didn't get their areas selected in time. But nevertheless, all those tracts have been selected. There's no anticipation changing those tracks, those are set in stone. We're not hearing conversations about the tracks being expanded or decreased. Whatever exists pretty much is in place. Now, anything can change. Obviously, Congress can change this, but to my knowledge, there's no, at the moment anyway, there's no proposed legislation to either remove census tracts or expand it. So whatever exists is for the moment. Next slide. So let's talk through broadly what exactly is this opportunity zone incentive and how might it work. So real quickly, I'm going to give an example. If a taxpayer sells IBM stock and they sell the IBM stock that they hold individually, this is an example. They hold the stock individually and they sell it for $100,000 and they have a $30,000 gain. So their basis is $70,000 and the gain is $30,000. In an opportunity zone picture, the taxpayer can say, look, I have a $30,000 gain. I want to defer tax on my $30,000 gain, and I would choose to put the $30,000 into an opportunity zone venture. You can put it into a fund, which is a partnership that perhaps husband and wife might own, or you can take your $30,000 gain and invest it in someone else's fund. So taxpayer incurs a gain. It's IBM stock in my example. It's a $30,000 gain. They only have to roll over to 30. They don't have to roll over the 100. You have to roll over to 30 generally, and there's some specific rules on this, but generally you have to roll over to 30,000 within 180 days of the gain into a fund. So if a taxpayer has a gain, 30,000, they roll the gain over within 180 days into a qualified opportunity zone fund, then they don't pay tax on that gain generally for 7 years until December 31st, 2026. At least that was the rule through 19. If somebody incurs a capital gain in 2020, the gain still must be recognized in 2026. So the point is, it was a 7-year deferral period if the gain took place in 19. It's a 6-year deferral period if the gain takes place in 20, and then it decreases accordingly. So, but in my example, $30,000 gain, taxpayer duly within 180 days puts it into a fund. They do not pay tax on that $30,000 gain until December 31st, 2026, and up to 15% haircut. So not only do you get a 7-year deferral generally, you get a 15% haircut on the gain. So $30,000 taxed in 2026 times 85% would be the tax consequence. So the taxpayer gets a 7-year deferral and a 15% haircut. I call that side one of the coin. Next slide, please. So that's the 15% haircut. And so, and if you invest by December 31st, 2019, you get the full 15%. If you invest into a qualified opportunity zone in 2020 and for the next few years, you're only going to get a 10% haircut on your gain. So you're not going to get the full 15%. But side one of the coin, if a taxpayer incurs a gain in 180 days, they put it into a qualified fund, generally don't pay tax until 2026, and you get some haircut on the gain. That's side one. What's side two? The real home run with the incentive, next slide please, is the real home run is if a taxpayer holds their investment in the fund for 10 years, so basically another 3 years generally after 2026 if they invested by 19, etc. If you hold your investment in the fund, in the venture, in other words, in the project for a total of 10 years, any appreciation over your original $30,000 and you sell your investment into the fund, from the fund, any gain over the $30,000 that you put in is tax-free. So that's the real significant benefit here. So 7-year deferral, you get a haircut on your gain, the gain gets taxed. So that's one of the misunderstandings, by the way, in the program is it's tax-free. No, the gain that you put in is taxed. And by the way, in order to take advantage of the incentive, you must invest a gain. You can't just invest regular dollars into an opportunity zone fund and say, I want to get the 10-year tax-free piece. That does not work that way, and in fact, the December 17 legislation made it clear that you have to invest deferred gains in order to take advantage of the 10-year tax-free piece. If a taxpayer invests deferred gains and they invest regular dollars, after 10 years, some of it will be tax-free and some will be taxable after 10 years. Next slide. So real briefly, this is to go over, and Chris is chomping at the bit, by the way. You should see him, how excited he is to get into these new rules. I want you to know that. So real quickly, this is a slide to simply say there's investors to the left. They have 180 days to invest into a qualified opportunity zone fund. That's nothing more than a partnership. That partnership, in turn, must invest in a qualified opportunity zone business, which again is nothing more than an operating company. It's a trader business. It could be, in this example, a restaurant, manufacturing business, a tech startup. It could be a real estate business. But the investor has 180 days to put money in the fund, and then the fund has generally 180 days. You know, they have 180 days from the date of the gain to put into the fund, and then the fund, once they get those dollars, they generally have 180 days to put their dollars into a business. And in this slide is to say, as an example, it could be a restaurant, manufacturer, tech startup, or real estate, et cetera. Chris, next slide.
Thank you, Stephen. So Stephen kind of laid out, you know, what the incentive is, you know, why, how would investors, what's the source of the funds that we're talking about that could benefit operating businesses operating within the zone. You know, again, it's being driven by incentives, tax incentives provided to private investors related to the deferment of capital gain and then the potential exclusion of appreciation on their investment. So it's a tax incentive to drive private investment into operating businesses in the opportunity zones. So he talked about how investors recognize those incentives and what they have to do to recognize those incentives. And the primary piece of that is, investor has to invest in a qualified opportunity fund within 180 days of recognizing the gain, which raises the question, what is a qualified opportunity fund? And as Stephen pointed out too, it's just the investment vehicle. Could be a partnership, LLC, could be a corporation, S Corp, just the entity that's organized or formed for the purpose of investing in qualified opportunity zone property. So Stephen and I could form, Stephen and Chris LLC. It could be our qualified opportunity fund. We invest our deferred gain into that LLC, and then we use that to invest in qualifying property within an opportunity zone. What controls and restrains that fund, so it's not just investing in stocks and other items to just get a tax incentive to the investors, is that the fund, at least 90% of the fund's assets must consist of qualified opportunity zone property. And as Stephen pointed to, that's a semi-annual test. The qualified opportunity fund self-imposes that test after the end of its first 6-month period of being recognized and operating as a fund, and then at the end of the tax year for that entity. So if you're in a year in which the entirety of that year the entity's operating as a qualified opportunity fund, you're going to have a test at the end of June and then a test at the end of the tax year, December 31. And then those two amounts are then averaged to see if the fund meets that 90% test for the entire year. 90% is just simply investing in a business that's located in a zone. Could be, yeah. And it just has to be invested in qualified opportunity zone property, and we'll get a little bit as to what that is. And so those tests are reported on the Form 8996 that Stephen referenced. The fund itself elects to be treated as a qualified opportunity fund on that form as well, and then designates in the initial year of operation to the IRS what month they would like that designation to begin. So very careful to make sure if those out there have already formed a fund that received investment in 2019, that when you're filing the 2019 return for that fund entity, You want to make sure that you're designating a date prior to the receipt of those investments into the fund, because if you designate after, those investments are non-qualifying if they are made prior to the designation date. But the self-certification, not to badmouth or denigrate any other tax credit or tax incentive programs out there. There's a lot of good programs, both state and local and federal, we're involved with, and that many of you all are probably familiar with. But they are generally, there's a process, there's a lot of steps, approvals, submissions. Here, the Qualified Opportunity Zone incentive was designed to be kind of streamlined in that you can self-certify the initiation of your fund, formation of your fund. There's no requirement that IRS approve the particular business or structure that you're investing in. You just have to make sure in planning that structure that it complies with the statute and the regulations that have been provided. Next slide, please. So fund has to meet the 90% test of investing in qualified opportunity zone property. There's basically three buckets that qualify. The first two are kind of the same. It's an equity stake in an opportunity zone business. So either stock in a corporation or S Corp, or partnership interest in an LLC, limited partnership, general partnership. That's one of the elements, types of property that can qualify is qualified opportunity fund, acquires stock in the corporation, the business, or acquires the partnership interest in the business, depending on how that entity is formed. The other is that the qualified opportunity fund can own what's called qualified opportunity zone business property, which is essentially just tangible property utilized in a trade or business activity in the zone, can acquire and hold that directly. Typically, just based on all the different elements under the qualified opportunity zone regulations and the statute, you're going to see most funds owning an equity stake in an opportunity zone business. That's going to be how most structures are. You're not going to have a whole lot of funds structured where the fund is holding the property directly. There's a variety of reasons for that, but generally that's going to be the structure that you're going to see.
And these could be existing companies or new businesses, it doesn't matter.
Yeah, so it could be entities originally formed for the purpose of operating as an opportunity zone business, or a existing entity that's operating in the zone or operating outside the zone looking to move into the zone.
Right.
Could take advantage of the qualified opportunity fund investment, as long as that existing business meets the requirements of a qualified opportunity zone business. So next slide, please. These two are relatively, the next two slides, again, it's just outlining what it means to be qualified opportunity zone stock, qualified opportunity zone interest. Again, it's a equity stake in an opportunity zone business, and that's important to understand for those of you that are looking to invest in a qualified opportunity zone business, or if you're operating a business, looking to start a business, wondering how you can take advantage of this potential additional capital. You have to understand that the fund is going to be acquiring an ownership interest in the business. You're welcoming in another stockholder, another member into the entity. So the fund will have all the rights that an owner has in that entity, and that's something to understand. Much different than financing or a debt structure where you just have an obligation to repay, yet you retain complete ownership of the business. In this particular structure, the fund itself will have an ownership stake, a seat at the table in the operation of the business itself.
Could be, they could have a non-voting.
Yeah, now it could be structured in ways that maybe would protect your interest as the original shareholder, though the individual or entity that's responsible for operating the business. You have a variety of ways that that interest could be structured so that you retain control, but a lot of that's going to be dependent upon the fund investor too. They may want some control. They may want. So a lot of different considerations there that have to be looked at. But you can skip on to the next slide, please. Again, the same kind of requirements of stock. It's just an interest. We can go to the next slide. The final type of property that a fund can own is the Qualified Opportunity Zone business property. Again, this is generally going to apply to analyzing what a Qualified Opportunity Zone business is, the type of property that the Qualified Opportunity Zone business has to own, but it can be owned directly by a fund as well. The important things to point out here is that to qualify as Qualified Opportunity Zone business property, the property has to be purchased from an unrelated party after December 31st, 2017, and the original use of the property in the Qualified Opportunity Zone has to begin with the purchaser, whether that's the fund or the business. If it does not, so say if a fund or business acquires a building located in an Opportunity Zone, the original use of the building does not begin with the purchaser, so there's a requirement to substantially improve that property. Again, this is designed to incentivize long-term capital investment in economically depressed, tracts of the country. So Congress didn't want to encourage just the acquisition of property and holding it. They actually want substantial investment improvement in that zone. So the extent that property is purchased after December 31st, 2017, and it has already been used in the zone, there's a requirement to substantially improve that property. We'll talk a little more about what that means, substantially improve. Original use means for purposes of has the property been placed in service for purposes of depreciation or amortization? So you could have potentially a situation as outlined in the preamble to the final regulations where a project could be near completion, yet not placed in the service for federal tax purposes, and fund or business could acquire that project, and original use would begin with the fund or the business. With respect to unimproved land, so land, if you're just buying dirt, there is no requirement to substantially improve the unimproved land. And again, this would also apply to if you're acquiring a building within the zone, the underlying land, to the extent that some portion of the purchase price can be allocated to the underlying land, there's no substantial improvement requirement for the underlying land. You would only have to substantially improve the building itself. So if the property was $4 million and $3 million of that can be attributed to the building and $1 million to the land, your substantial improvement requirement is only going to focus on the basis, the portion of the purchase price associated with the building.
And we would normally recommend get an appraisal to do that allocation. And it may not be so uncommon that under a $4 million acquisition, perhaps the land, your example, could be $3 million and the building could be $1 million because the building needs attention. And it's sitting in maybe a corner lot that, is good access, very valuable land. And so you would only have to double, but again, you need to get an appraisal.
No, it's true. So the issue with respect to unimproved land, there is a requirement that you don't have to substantially improve, but as long as it's used in a trade or business activity, you have to have more than insubstantial improvement. So, not a whole lot of description as to what that means, but we do have some examples that, if you were to acquire farming land and just continue the farming activity and not make any improvement, that doesn't qualify. If you were to install an irrigation system or do substantial grading, that potentially would qualify. The other downside to that in the final regulations talked about a parking lot and how that potentially may not qualify if that was the only intent of the property was paving and putting up a shack, for the parking attendant, that could potentially not qualify. So that's the some limitations on property that's acquired and what can be done. There also have been some changes made under the final regs as to whether the substantial improvement test applies to certain types of property, and we can discuss those later. Let's move on to the next slide, please. So here, the property will be treated as substantially improved if there's an increase in basis by the Qualified Opportunity Fund or the Qualified Opportunity Zone business over a 30-month period beginning from the date that the fund or the business acquires the property. So essentially what you have to do to meet this test is that whatever the purchase price is associated with the property, and again, when you're dealing with property that has an existing structure or building, you're only focusing on that portion of the purchase price attributed to the building. To the extent that you have purchase price associated with the property, you basically have to have improvement costs that exceed that purchase price. So if the purchase price associated with the building is $2 million, you would have to have costs improvement costs that exceed $2 million.
It's similar to like a trade or business. I don't mean to interrupt, but you agree with that, right? If you buy like restaurant, that sort of thing, you still have some improvement with the equipment. You're going to into some of that.
Yeah, and so that's one area where it's very the final regulations have been very positive with respect to the types of improvements that need to be made. To the extent that you're an operating entity that acquires a property and you're looking to under the proposed regulations as we were aware of them before the final regulations came out, to the extent you're acquiring a building as an operating entity, say you're a manufacturing facility, you would have to substantially improve the actual building. So if the cost of the structure was $1 million, you'd have to make improvements to that structure of more than $1 million. Well, what if you were also putting in equipment and other items that potentially weren't considered improvements to the structure itself? There was a concern that you would not be able to satisfy the substantial improvement requirement with respect to the building, that those are just standalone qualifying items that wouldn't impact that improvement analysis. So, very difficult in a lot of different scenarios that taxpayers are not allowed to aggregate all of those costs, whether it's improvements to the structure, acquisition of new equipment or tangible property that improves the functionality of the structure. There was always a push from a variety of different groups that could we kind of aggregate those costs for purposes of substantial improvement. None of the final regulations you can. You have the ability to aggregate in that scenario not only the improvements to the actual structure that the manufacturing entity acquires, but any tangible property acquired that improves the functionality of that building. So, that are used in the trade or business activity. So all those costs, whether it's equipment, whether it's office furniture, new computers, all going into the offices that may be in that building, they would all be included under the new aggregation rules to complying with that substantial improvement requirement. Additionally, to the extent you have more than one building that make up your operating entity, that make up your operating business, you can aggregate costs across those buildings. So to the extent you had one facility that needed minimal improvements, you have another facility that needs substantial improvements, you acquire those buildings to the extent that you're permitted under the regs to aggregate those, that they're on contiguous parcels, they're utilized in the same kind of trade or business activity, there's joint functionality and interdependence between the use, then those improvements to the one building can be aggregated over the two buildings to where you can bring both of those properties into qualifying property status for purposes of the original use requirement. In addition, the final regulations provide some release from the original use requirement as it relates to a lot of different types of property, brownfield sites. To the extent you're purchasing a qualifying brownfield site, you can treat all of that property under the final regulations as satisfying the original use requirement, as long as within a reasonable period you're making some investments to ensure that that property has been remediated. But to the extent that it's a brownfield site, you don't have an original use requirement. You're treated as the original user, as the purchaser. Therefore, you don't have a requirement to substantially improve that property. Now, again,
your money. You
don't have to increase the basis in excess of the purchase price. But to the extent that you're utilizing that property in an operating business activity, you would have a requirement to improve it more than insubstantially. You can't just hold that property in the business. There'd have to be some improvements related to the trade or business activity. In addition, real property this includes the land and any buildings on the land that are purchased from a local government that the government holds because it was abandoned or foreclosed on, or there's some type of involuntary transfer that led to the property ending up in the hands of a local government. You have the ability to treat that as original use property, and there's no substantial improvement necessary. So that's kind of the requirements as to what's necessary for the fund, the type of property the fund has to own, can invest in an operating business, opportunity zone business. That business has some requirements that it has to meet as far as 50% of its gross income has to be earned within the opportunity zone, and it has to own at least 70% of the tangible property owned or leased by the business has to consist of qualified opportunity zone business property. So there's some additional slides that we've included just for your benefit that kind of, in a real summary fashion, touch on some of the changes that were brought about through the final regs. We've touched on a lot of those in talking through and what we're doing. But it's the requirements have been relaxed fairly substantially in a taxpayer-friendly way, and a lot of definitive answers put on a lot of different issues that following the second round of regs, we were unsure about. So you see there, what is a qualified opportunity zone business? Again, at least 70% of the tangible property owned or leased by the business has to be qualified opportunity zone property. That's the property we were talking about, purchased after December 31st, 2017 from an unrelated party. And to the extent original use doesn't arise with the purchaser, you have that requirement to substantially improve. You also have a 50% gross income test in that the active conduct with trade or business in the zone has to generate at least 50% of the total gross income of the business. There's some safe harbors under the final regs that permit you to evaluate that, what that actually means, to the extent you're providing services outside the zone, to the extent you're selling inventory and property outside the zone. There's ways in which you can still meet that test.
Even if I'm located in the zone, some of my activities outside the zone, I can still get it to qualify.
You can. There's a lot of different ways in which figure out ways that qualifies. It definitely Congress didn't intend for this to be a limiting structure with respect to encouraging business activity in the zone. So it's a very broad and expansive kind of facts and circumstances test, focusing on where management activities occur, where tangible property is located, what level of compensation or hours of employees within the zone and independent contractors within the zone. So there's a lot of different tests there to evaluate whether the business meets that test. We can move on to the next slide. So this is just, the kind of summary of a lot of different factors that we received guidance under the final regs, some clarifying points, some definitive points, very helpful and beneficial. The leased property, leasing of property, real property is an active trader business. There's some concern about that prior to the final, at least the second round of regs confirming that in part. But there was the issue of a triple net lease, that not being an active trader business to the extent you had a truly kind of passive lessor relationship. That's still the case. You can't just acquire property, develop it, and then have a triple net lease arrangement with your tenant. There has to be some operating management component, active conduct of a business component. However, you can have, to the extent you have a larger leasing business, say you have multiple properties or multiple floors within an existing property, if some of those relationships are a triple net lease, that won't blow your conduct as an operating entity as long as it's part of a larger leasing business. The big piece for operating business entities is the reasonable working capital safe harbor. To the extent that you have an investment coming from a fund into an operating entity, as long as it comes in pursuant to a written plan as to how those funds are going to be used and those funds are used consistent with that plan, it's a working capital safe harbor applies for up to 31 months within the business. This is done to facilitate startup businesses who may not be operating from day one and they're holding that cash. It doesn't violate the 70% test if it's being held consistent with the working capital safe harbor. The final regs clarify how that can be used. So, that could be used for purposes of, paying, if you're a tech company, you've got software engineers and technicians and scientists, you've got employees, you've got third-party consultants. If you're a restaurant, you've got, your local permits, your licenses, your hiring and training your staff. All those are costs that those funds coming into that operating business, those funds can be used to help push and develop and get the business ready for moving forward and operating. To the extent that there's some permitting delay that prohibits the business from expending or developing, the 31-month period is told, that working capital safe harbor period is told. And then to the extent that the fund is making multiple investments in the business, there's an ability to extend that working capital safe harbor as new capital is coming in up to an aggregate total of 62 months. So there really is a large window there where operating entities, startup businesses can take these funds in. They're not under a whole lot of time pressure. They can use those funds to develop and grow and get the business up and running.
And that was all with the final regs.
That was all with the final regs.
It's very taxpayer friendly.
Yes, yeah. And again, next few pages you can look at on your own. If you have any questions, we're happy to answer them. But again, this is just kind of a good summary of the final regs, some of the key points. And I know we threw a lot at you in about 30 minutes. I apologize. And hopefully in the Q&A we can address some actual concerns. But that's it.
Great. Thank you, Chris and Stephen. That was a great overview. And I do just want to let folks know that we are going to be recording this webinar and making all the slides available to the participants, as well as posting it on the Consortium website. So if you didn't catch all of that detail or want to go back and revisit it, that will be made available to you. We've also had a few questions coming in to that effect and otherwise. So if you do have a specific question you'd like us to address, feel free to type that into the Q&A comment box on the right side of your screen. We're screening those questions, trying to pull some of the most relevant ones to the top. And if we don't get to your specific question, we'll be addressing some via email as well in kind of a wrap-up. So definitely take advantage of that resource too. I now want to pass things off to Matt Toohey with IEDC, the Indiana Economic Development Corporation, to talk about some companion tools that would work well with Opportunity Zone projects here in the state of Indiana.
Thanks, Emily. As you can see here on the first slide, we have a couple of the major tools that are offered by the IEDC to companies here in Indiana. The first one I'll talk about is EDGE. It is a refundable corporate income tax provided to the business to support job creation and capital investment. The credit is calculated as a percentage of the expected increase in tax withholdings generated from the net new jobs that are created by the company. The credit can be phased in up over 10 years based upon the projected employment ramp up when the company provides their investment plan to the IEDC. SEF, the Skilled Enhancement Fund, provides assistance to businesses to support training for upgrading employees' skills. The grant may reimburse for up to 50% of eligible training costs over a 2-year period. The training must lead to a post-secondary credential, a nationally recognized industry credential, or some specialized company training that's specific to that entity or to that company. It may be used for both new hires and existing workers, and for existing workers, an increase in wages is expected as well. On the next slide are some other programs that received some updates during this past legislative session. The first one, the Headquarters Relocation Tax Credit, was expanded. The Headquarters Relocation Tax Credit provides corporations who relocate their headquarters to Indiana. The credit is assessed against the corporation's state tax liability. It is expanded to include small headquarters relo tax credits. It is a refundable tax credit to the small high-growth business that relocates their headquarters to Indiana or relocates a number of employees that equals 80% of the company's payroll to Indiana. And again, this credit is assessed against the corporation's state tax liability. The Venture Capital Investment Tax Credit Program was added with transferability this past legislation, meaning that for investments made on or after July 1st of this year, investors may transfer or sell their tax credits. The limitations on this are the tax credits must be in a minimum of a $10,000 size, and once the seller transfers that tax credit to another entity or an individual, that buying individual or entity may not transfer the tax credit once they obtain that. The Venture Capital Tax Credit Program provides up to a 20% tax credit towards Indiana tax liability based on the investment that they made. A qualified company may offer its investors for a lifetime maximum of $1 million in tax credits. So a company can go out and raise up to $5 million and offer their investors up to that $1 million in tax credits for investing that money into them. The next program on the list is the Innovation Voucher Program. This is a new program that will provide grants to eligible small businesses to be used for that business to purchase research and development support or other forms of technical assistance and services from Indiana institutions of higher education or an authorized research provider. The company has to have less than 150 total employees, and the IEDC has set aside $500,000 towards these vouchers. And the awards will vary based on the company need and the level of matching funds that the company brings for those investments. The redevelopment tax credit is a new incentive for investment for the redevelopment of vacant land and buildings, as well as brownfields. The credit provides companies and developers an assignable income tax credit for investing in the redevelopment of those communities, improving the quality of place, and building capacity at that local level. The IEDC may award up to $50 million in tax credits each fiscal year towards this program. The Business Promotion and Innovation Fund was established to promote business investment and encourage entrepreneurship and innovation around Indiana. The fund may be used to encourage regional development initiatives, incentivize direct flights, both internationally and domestically, to and from airports across Indiana, advance innovation and entrepreneurship education, programming, and resources through strategic partnerships, promote the state of Indiana and its competitive business climate to national and international audiences, as well as support activities that encourage international growth and trade. And you can see the first bullet point under the modernization section, there has been a change to the Indiana taxing code regarding how service companies are taxed. And then the last update is to the Hoosier Business Investment Tax Credit Program. This is a non-refundable corporate income tax credit to businesses to support job creation and capital investment. The credit is calculated as a percentage of the eligible capital investment that was made, and the credit may be phased in over a 2-year period for that company. Emily, back to you.
A few of the early projects that have emerged in Indiana were actually in a very small town. So we know that, you know, the challenges and opportunities in urban and rural settings are very unique. And it was really surprising and exciting to see that a very small town of, you know, under 10,000 people was able to close some of the first opportunity zone projects in the state. So the 3 examples that were actually capitalized or kind of captured in a case study that was recently developed were a historic Main Street mixed-use development in downtown Brookville. And then as part of that, in that area was a local newspaper that was a small business, you know, sort of owned and operated in the small town, and that newspaper was acquired. And then a hotel franchise that opened in a historic building in that area as well. So these are different, unique examples, both using real estate and an operating business. And, you know, all the details about those projects and the approach have been captured in a case study. And so you can find those on the Opportunity Investment Consortium website. And, you know, we think that these were really great examples that came online early and the developers have been really willing to kind of share best practices and kind of the stumbling blocks and realizations they made through the process. So I think we maybe have Lindsay ready to go now. Let's try that again.
Can you hear me now?
Yes, that is better.
Okay, great. All right, thank you so much, Emily, and hello to everyone. My name is Lindsay Malici. I'm here in the U.S. Small Business Administration's Indiana District Office, and I'd like to start by talking to you about what the federal government is doing in general as it relates to opportunity zones, and then I'll focus on SBA. In order to amplify the impact of this tax incentive, the White House Opportunity and Revitalization Council was formed to better coordinate federal resources in opportunity zones. And so the council is working across 4 different work streams, and they are economic development, education and workforce development, safe neighborhoods, and entrepreneurship. And the council has already taken action to align more than 160 federal resources across the different agencies with opportunity zones, which you can find at opportunityzones.gov. So to give you a couple examples, the U.S. Department of Agriculture added priority points for their Rural Business Development Grant. So applicants who have projects that support small businesses in rural opportunity zones can get some added priority points. USDA recently awarded a Rural Business Development Grant to the Indiana Office of Community and Rural Affairs, OCRA, who is working alongside the Purdue Center for Regional Development to assist rural Indiana communities as they develop their opportunity zone investment prospectuses. Anyway. Another example, the Economic Development Administration has added opportunity zones as an investment priority for their grant programs supporting development in economically distressed areas. So projects like the City of Evansville's revolving loan fund for small businesses and Pike County, Indiana's new Entrepreneurship and Tech Center, which were supported by the EDA, will receive additional consideration if they invest in opportunity zones. So I encourage any local leaders to visit opportunityzones.gov to find a list of all the federal resources and consider these additional tools as you help revitalize your opportunity zones. Next slide, please. Okay, the U.S. Small Business Administration is the lead agency for the entrepreneurship work stream of the White House Opportunity and Revitalization Council. And so I would like to talk to you about the counseling, capital, and contracting resources that SBA provides to help small businesses start, grow, expand, and recover. SBA is a cabinet-level federal agency. We were created in 1953. The Senate just confirmed our 26th administrator, Jovita Carranza, and although I'm sitting here in the Indiana District office, we do have offices located across the country. So with counseling, in addition to the wealth of information available in our business guide and learning center at SBA.gov, small businesses and entrepreneurs can take advantage of no-cost counseling available through our SBA resource partners, and you can see them listed here on the left. They include the Small Business Development Centers, SCORE Volunteer Mentors, Women's Business Centers, and Veterans Business Outreach Centers. And these folks will sit down with you one-on-one to advise you on different topics affecting your business, including finding opportunity zones and opportunity zone funds. No matter where you are in the country, you can go to SBA.gov and click on local assistance to find SBA resource partners in your area. Moving on to capital. So opportunity investment may not work for every business. So SBA's funding programs offer more arrows in the quiver. We work with SBA-approved lenders to make it easier for them to provide loans up to $5.5 million to help start and expand businesses, often with more flexible terms than what would be available without an SBA guarantee. I know we have some of our SBA lenders on the line here today, and I'm sure they would love to work with you. And you can find participating SBA lenders using our free online referral tool called Lender Match, available at sba.gov/lendermatch. Small businesses can also find investment in the form of debt and equity through a small business investment company, or SBIC, which is licensed and regulated by the SBA. In the past 10 years, SBICs have invested $551 million in 125 Indiana small businesses. To find those SBICs, you can visit sba.gov and find the SBIC directory under funding programs. A couple others I won't spend too much time on, but so you're aware, SBA also guarantees bid performance and payment surety bonds to help small businesses win contracts. And we hope it never happens, but in the case of a declared disaster, we do provide low-interest disaster loans to help not only small businesses, but also renters and homeowners recover. Moving on to grants. Federal grants are available at grants.gov.gov. And a couple that affect SBA, we work with different federal agencies that provide grants under the Small Business Innovation Research and Small Business Technology Transfer programs. So these are competitive grants for small businesses engaged in research and development with the potential for commercialization. So maybe some of these tech startups looking in opportunity zones might be able to take advantage of some of these competitive grant funds. Elevate Ventures here in Indiana also provides matching funds to SBIR recipients. So a great incentive there. If there are exporters in these zones, the Indiana Economic Development Corporation just launched the Indiana State Trade and Export Promotion Program, supported by an SBA grant, which will provide funding for Indiana small businesses to participate in export-related activities. There are a couple grants available to growth accelerators and makerspaces that support entrepreneurial development. So these growth accelerators and makerspaces can receive additional preference on their SBA grant applications if they are supporting entrepreneurs in opportunity zones. So a couple that were awarded recently for the Growth Accelerator program, the Northeast Indiana Innovation Center received an award, and in Indianapolis, Ruckus Makerspace received an SBA award to provide training. So again, grants you can find at grants.gov. So there are many funding options available, and I encourage small business owners to visit SBA.gov and also to reach out to those resource partners on the left to help assess their options. And finally, contracting assistance. The federal government, which is the largest buyer in the world, uses special programs to help small businesses win at least 23% of all federal contracting dollars each year. And in particular, there is significant geographic overlap between opportunity zones and SBA's historically underutilized business zones, or hub zones as we call them. A small business with a certification from SBA saying they're located in a hub zone and meet a few other criteria have a competitive advantage for winning those federal contracts. The Economic Development Administration and Indiana University recently launched the USA Opportunity Zones tool, which will tell you if, among other things, an opportunity zone is also a hub zone. SBA also has federal contracting certifications to help level the playing field for women-owned small businesses, woohoo, service-disabled veteran-owned small businesses, thank you for your service, and for socially and economically disadvantaged small businesses. And there is no-cost government contracting assistance available through the Procurement Technical Assistance Centers, the PTACs, which you can also find using our local assistance map at SBA.gov. And by the way, you can determine if you qualify as a small business by visiting sba.gov/size. We work with mom and pop shops as well as 1,000 employee ice cream manufacturers, and we'd love to work with you. So I'm sure we're all excited to get to the Q&A portion. So that's all for me. Thank you so much.
Great, thank you, Lindsay. I do want to stress for folks this opportunity to really think about what leveraging the Opportunity Zone designation for your community can do with helping to unlock additional federal grant opportunities. So, we've had partners, community partners here at LISC reach out to us to say, hey, we're in an opportunity zone. What does that mean for us? But realistically, they may not be in a position to take advantage of some of the resources and opportunities that Chris and Stephen talked about because they're not engaged in real estate transactions. They're not necessarily engaged in business transactions either, but they might be a community center. They might be a nonprofit organization providing training or other technical assistance. So really take advantage of looking at how leveraging the designation for geography can impact those additional types of programs that are receiving preference points and kind of additional consideration by multiple branches and divisions of the federal government to unlock additional opportunities for the neighborhoods and communities that you are working in. So thanks again to all of our presenters. We do want to go ahead and spend the rest of our time together focusing on question and answer. So we appreciate all of you who have submitted questions. So I'll kick off a few general ones. If any of the panelists would like to chime in, they can, and a few will be directed to particular panelists. So first, Stephen and Chris, could you give us an example of a company that you've worked with that was exploring the feasibility of using the Opportunity Zone incentive to grow its operations? How did the company benefit from the incentive? And in your opinion, does the impact of the incentive vary on the type of business? So example, retail versus tech versus manufacturing.
Want me to hit that first, Chris, a little bit?
Sure.
Chris knows I enjoy talking, so thank you. Great question. And one, it actually does oftentimes matter the type of business. So why? So let's answer that question first. Whether it's technology, as you say, manufacturer, could be a restaurant, could be a franchisee. As an example, if I don't want to start dropping franchisor and franchisee names, but my favorite is Popeye's fried chicken, so I'll just say that. But nevertheless, and that's not one that we're working with, so I want to make that real clear. But nevertheless, let's say an entrepreneur wants to own a Popeye's franchise location, and they want to locate one in an opportunity zone. Let's say it's brand new. That actually might work. Oftentimes, franchisees, so it could be a single business that, you know, has to pay franchise fees and all that. They're located in an opportunity zone. Oftentimes, like pizza places, chicken, you know, we can think of other fast food. They do have significant upside. They go in, develop a nice market, develop a nice client base, and somebody later will buy that business. So what's the significance behind what I'm saying? It typically, if it's a trade or business, or really any business, but in particular trade or business in this discussion, it has to have growth. There has to be an upside. If an investor, opportunity zone investor, invests in one of these startup companies or an existing business that might locate in an opportunity zone or already is in a zone, there has to be upside. That will attract the opportunity zone investor. Why? It's the 10-year tax-free piece. That's generally their motivation. They want to go into the company, it'll grow, it'll increase in value. After 10 years, there's some kind of exit strategy, and they can sell tax-free.
I would just add, you know, and I know a lot of you probably heard this, you know, the opportunity zone incentive, you know, it's an incentive to drive the private investment. It doesn't make a bad investment a good one. It's just an incentive to drive private money into opportunity zone tracks. And so the type of business, from an investor standpoint, if you're looking from a business opportunity, our clients, you know, are seeking investments in their business. You know, the type of business is going to drive a lot of whether investors are interested, in that type of business, whether it's something they feel comfortable investing in, whether, as Stephen said, they feel it's going to provide an adequate upside or will have an adequate return over the life of the investment. So the type of business is critical from an investor standpoint. And then from an operating entity standpoint, the type of business can be critical depending on whether you can actually meet the tests of an opportunity zone business for purposes of accepting a qualified opportunity fund investment. So if you're an existing entity, you have a lot of equipment and other items that you purchased prior to 12/31/2017. You know, maybe there's not a whole lot of room to expand or desire to expand. You know, you may not be an entity existing-wise that would qualify as a qualified opportunity zone business to accept that investment. So, you know, we're generally seeing startup companies or companies that have a desire to significantly grow or expand their operations. You know, we're working with a food production company right now that's really kind of hit a niche market, and they could expand exponentially if they just had the capital to increase their manufacturing capability. And so that's a prime example of they're looking at space in an opportunity zone to acquire a building, build out their line, and locate their headquarters within the zone. So that type of project is one that is ready-made, that you can have an expansion, development within the zone. You're acquiring tangible property for the first time, utilizing it in the zone. You're making substantial improvement to the facility that you're leasing or acquiring. But, you know, so it really depends on what the goal of the business is. I mean, if the business is just an existing restaurant that's relatively young, that doesn't have a whole lot of need for development and expansion or new equipment, you may not fit that mold. And I need to tie all of this to, you know, profitability and whether it's a good investment for the investor, but that's what's going to drive the investment. You know, but there are, to the extent you're looking to utilize this for community growth, nonprofit development, those are also potential structures that could work. I mean, we're working on a very large nonprofit construction project in Louisville, about a $35 million expansion that is going to be funded in part by Opportunity Zone money, but you're looking at, social impact investors who maybe aren't as concerned about a large return or appreciation and just looking at getting a social benefit from their investment.
Great, thank you. So in thinking about how a business might be able to attract this type of investment, are there things that a small business can do or should do to increase the likelihood of securing an Opportunity Zone investment?
Yeah, this is Chris. I think again, along the lines of what we were just talking about, I think you would need a plan as to what you're going to utilize that additional capital for. There has to be some use as to growth or new construction or expansion. Is there a need? Is there a use where it would make sense that you would have a significant capital raise? Those funds are going to have to go to some type of capital investment in the business. So the business is going to have to have a need for that investment. So having a plan in place as to what you're going to use those funds for, how they're going to be deployed, what's going to be acquired, what the plan is. One is necessary for purposes of meeting the working capital safe harbor test, but two is going to be important to be able to provide to investors so they can see where exactly their money's going to, how it's going to be utilized, whether that's attractive to them as an investor. So I think really exploring what if you're relocating into a zone and expanding, if you're looking to open a new location, if you're looking to start a business from scratch, a plan as to how those funds will be utilized, how they'll be deployed, what they're being raised for, it would be substantially important in making yourself available to exploring investment on the Qualified Opportunity Fund side. So that would be my,
yeah, and I'd add real quickly, that's exactly right. Very quickly, I'd say, this is obvious, but as the entrepreneur is seeking the capital to grow their business and there's potential upside the way Chris is describing, if they too have also explored some of what we're talking today, it's very common that the small business is eligible for other incentives, and we've seen that. So if it's, TIF dollars, if there's other economic incentives, property tax abatements, if all that has been explored, coupled with the Opportunity Zone incentive, that generally appeals to the investor.
That's great to hear. So one of the questions that we got through the online Q&A was, when a Qualified Opportunity Fund is formed, is that information made public? How would someone or could someone find out if a Qualified Opportunity Fund exists or has been created in their community?
There's no requirement if Stephen and I are to form a Qualified Opportunity Fund, the only people that are going to know about that, to the extent we don't want to disclose it, are ourselves and the IRS, and to a large extent, I guess, the state Department of Revenue, or there's a state credit or other federal credit. I mean, there's no obligation to disclose that or make it available. There's not a repository where all the funds' names and their creation has been identified. I mean, there are some groups out there that are trying to gather, to the extent that people are willing to share, that these funds exist. But there's no. I mean, there's Novogradac. Yeah, Novogradac is one group that has worked to try to put some information together. I think the state of North Carolina, their Housing Development Corporation, has put together some information as funds that are out there, and other states have tried to put. I know Tennessee has put together a website through their economic development.
volunteer.
group, and it's all whether the fund wants to disclose that information or not.
That
So,
is one of the bigger frustrations, because if I'm an entrepreneur, I have an idea, I need capital, and I'm in a zone, how do I pitch my deal? We do hear that, and so that's why Chris is describing. Some organizations recognize that and they become a repository to the degree people want to voluntarily disclose they have a fund.
Yeah, so that's actually a great question of just how do you find an investor? And so I think in Indiana, one of those potential opportunities for someone who is not already connected to investors or wouldn't know where to approach them is to spend some time on the Opportunity Investment Consortium of Indiana's website. So there are a number of both public and private investors that are members of the consortium. And there's actually a deal portal. So if you are investing in a real estate project, or you're planning to develop a real estate project, or you're looking to start a new venture and you're interested in getting in front of investors that may have opportunity funds or other incentives or resources that could help move that project forward, you can input some very basic information about the project on the Post an Opportunity tab, and include some information about what you're looking to do. And that information will actually get sent out to a number of investors on that portal who can take a look at your project and see if it's something that they may have some resources, may have an opportunity fund that would be a good fit to move that forward. So I would encourage folks in Indiana to consider that as a way to connect to investors if they're struggling to know where to start. And there's also an opportunity to sign up for the newsletter on the Opportunity Investment Consortium website. Other resources from groups like EIG and Novogradac and statewide partners are being sent out to our local newsletter members whenever we get those. So those are a great way to keep up on the trends both locally and nationally. So
that was very helpful. That makes sense. That's good.
Yeah. So we've had a wide range of projects come through the Post an Opportunity link on the Opportunity Investment Consortium, everything from pretty traditional housing projects to kind of green energy startup ventures or kind of exploratory social ventures and other real estate projects. So it's been a really wide range, and that's a great place to start. And many of the resource partners and investors on there can point you in the right direction if you're not sure whom you should be reaching out to or how to get in front of the right types of investors. We may just touch on one more quick question here. So that came through. So with regard to substantial improvement on property, how is new construction treated?
Yeah. So again, the fact that if you're acquiring unimproved land, then there's no requirement to substantially improve the unimproved land. So all of the new construction would be qualifying property in the hands of the qualified opportunity zone business. So there's no threshold to meet on the new construction. Now, again, you still have the issue of with unimproved land, the improvement has to be more than insignificant or insubstantial improvement. So you couldn't just buy a 20-acre parcel and put a little shed out in the middle of it. It has to be some more than insubstantial improvement that leads to an increase in economic activity and use of that property. But to the extent you have new construction, you're building a new office space or mixed-use development, all of that new construction is qualifying property in the hands of the opportunity zone business. There's no requirement to substantially improve the land.
I think the April, which regs clarified that? Was the April 19, I think, clarified that?
Yeah, well, yeah, and it's clear in the final regs
exactly.
as well.
That's right.
Great. And so I'm going to do one last question, and this is kind of targeted towards Lindsay and Matt as government representatives. So can you fill us in on any activities that your organizations are taking to increase the visibility of opportunity zones and to make opportunity zone investments in Indiana more likely or more viable?
you'd like to start with?
Whoever just spoke can start.
Okay. This is Matt. I do know that here at the IEDC, our past president, Elaine Bedell, who is now heading up the new Development Corporation, she's always out speaking about the opportunity zones. Emily Chris here at IEDC, she is our main point person on behalf of IEDC that will interact with the local economic development organizations. Obviously, Emily, you know her from LISC. So she's the primary contact that is involved with the REDOs, LEDOs, and IEDA and other organizations to get the word out and promote that way. So I don't know what her calendar is. I don't know how much she's been on the road doing that, but I do know that there are at least a couple of folks associated with IEDC that are trying to put the word out there on the street for this, as well as the consortium here that we belong to.
Yeah, and on the federal side, I would point people back to the opportunityzones.gov website that lists all of the updates happening at the federal level, some background on the council's actions that they've taken, a list of those federal programs and resources that are available. And a lot of those resources and programs are focused on building capacity in opportunity zones, you know, regardless of whether or not an opportunity equity investment is involved in the project. So just really making an effort to build capacity in other ways as well. That's why we call them companion resources. And in addition, there are organizations who will be gearing up to do some more outreach to small businesses. The Small Business Development Center Network, for example, will be hosting opportunity zone outreach events so that we are getting the word out.
Great. Thank you, Matt and Lindsay. So we are just running up on 5 o'clock, so we want to thank everyone who was able to join us today for this webinar. We hope you found some of this information useful and you can put it to good work in the community that you're working in. We do want to thank Fifth Third Foundation for their support of the Opportunity Investment Consortium here in Indiana, and MCM and Cross Brown Todd for participating along with Matt and Lindsay. So as we stated earlier, this webinar was recorded, so we'll be sending that out to those who were in participation along with any other resources that might have been mentioned today, and we'll also have that on the consortium website as well. So thanks everyone for being involved, and we hope to connect with you in the future as more information comes out about opportunity zones and more exciting projects get closed here in Indiana.